Imagine it is the 14th of August, 2019. You are a 51-year-old civil engineer living in Beirut, Lebanon. Your apartment sits on the 7th floor of a building in the Hamra district, and from your balcony, you can see the Mediterranean on clear mornings. You have $68,000 saved in a Lebanese pound account at one of the country's largest banks. You also have a pension coming, contributions you have made faithfully for 22 years. Your children are grown. Your mortgage is almost paid off. You have dinner with your wife on Friday nights at the same restaurant you have been going to since 1998. By any reasonable measure, you have built a good life, a careful life, the kind of life that is supposed to hold. If you have ever wondered why intelligent, careful, hardworking people consistently fail to act on the warnings that, in hindsight, were always right in front of them, stay with me. What you're about to hear is not a theory, it is a pattern. It has played out in country after country, decade after decade, and it always ends the same way. The warnings were always there. The people who saw them were always dismissed as alarmists, and the people who dismissed them always paid the price. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Here is what happened to the civil engineer in Beirut. By October of 2019, street protests had erupted across Lebanon. By November, banks had imposed informal capital controls, meaning they had quietly started refusing to let customers transfer money abroad or withdraw more than small amounts of cash. By March of 2020, Lebanon had defaulted on its foreign debt for the first time in its history. And by 2021, the Lebanese pound had lost more than 90% of its value against the dollar. The $68,000 in that bank account, the savings of a disciplined professional lifetime, could only be withdrawn in Lebanese pounds at an artificially low official rate. In real purchasing power, what he could actually access was worth, by some estimates, less than $6,000. He had not made a single mistake. He had followed every reasonable rule of careful financial behavior, and it had not mattered. This video is about warning signs. Not the obvious kind that you only recognize once everything has already collapsed. The subtle kind. The ones that were visible in advance. The ones that, if you know what to look for, appear in the historical record like a trail of breadcrumbs, months and sometimes years before the final break. The question this video asks is not whether warnings exist before a major financial collapse. They almost always do. The question is why so few people act on them. And more importantly, what do the people who did act have in common? Before we go further, there's something important to understand about how warning signs actually work. Most people think a warning sign is like a red light at an intersection. Clear, unambiguous, stop or proceed. But financial warning signs are not like that at all. They are more like a smell in a house, something slightly off, something you cannot quite locate, something that could be nothing or could be a gas leak in the walls. The problem is that the smell has been there for so long that you have stopped noticing it. Your brain has adjusted. Your threshold for what counts as normal has shifted to accommodate the warning signal itself. And by the time the smell becomes undeniable, it is almost too late to leave calmly. This is the core mechanism behind why warnings get ignored. It is not stupidity. It is not carelessness. It is a deeply human cognitive process called normalization, which means the gradual adjustment of what your brain considers to be normal. The longer a dangerous condition persists without catastrophe, the more normal it starts to feel. And the more normal it feels, the harder it becomes to treat it as the danger it actually is. The warning sign does not disappear. It becomes background noise. Financial systems exploit this feature of human psychology without intending to. They do not become dangerous all at once. They become dangerous gradually, incrementally, in ways that each feel manageable in isolation, but are catastrophic in combination. And because each step feels like a small departure from the previous step, rather than a large departure from where things started, people rarely perceive the full distance they have traveled from safety until they can no longer get back. This brings us directly to the first warning sign and the first case study. And it begins not with a crisis, but with a party. Japan in the late 1980s was, by the standards of the time, the most impressive economic story on the planet. The country had rebuilt itself from the rubble of World War II into the world's second largest economy. Japanese manufacturing was dominant. Japanese companies were buying American landmarks. The Rockefeller Center in New York was purchased by a Japanese company in 1989. Golf club memberships in Tokyo were selling for more than $1 million. The Nikkei 225, Japan's main stock index, had risen from around 6,000 in 1980 to nearly $39,000 by the end of 1989, nearly 6.5 times in 9 years. Property prices in Tokyo had risen so high that at their peak in 1989, the grounds of the Imperial Palace in central Tokyo were estimated to be worth more than all the real estate in the entire state of California. The warning sign was there. It was in plain sight. It was, in fact, being written about and discussed in academic and financial circles throughout the late 1980s. The price-to-earnings ratio, which is a measure of how expensive stocks are relative to the actual profits of the companies behind them, had reached levels that were, by any historical comparison, extreme. In simple terms, people were paying enormous amounts of money for shares in companies whose actual earnings did not come close to justifying those prices. They were betting not on what the companies were earning, but on what other people would be willing to pay for the shares next month, next year. The price was self-referential. It was a number that existed primarily because people believed it would keep going up. This is the first warning sign that history identifies with almost painful consistency. When asset prices, whether stocks, property, or anything else, become disconnected from the underlying income or value those assets actually generate, the gap between price and reality is a warning sign. It always has been. It was true in Holland in 1637 during the tulip mania, when a single tulip bulb was said to trade for the equivalent of a skilled craftsman's annual wage. It was true in the United States in 1929. It was true in Japan in 1989. The valuations had become stories, not numbers. And when prices are held up by stories rather than earnings, the correction, when it comes, is not gentle. In January of 1990, the Nikkei began to fall. By October of 1990, it had fallen by 48% from its peak. By 1992, Japanese property prices had begun a decline that would last, in some regions, for more than a decade. Ordinary Japanese workers who had taken out large mortgages at the peak of the market found themselves in negative equity, meaning they owed more on their homes than the homes were now worth. Companies that had borrowed against inflated property values were suddenly insolvent. The Japanese banking system spent the entire 1990s, a decade now referred to as Japan's lost decade, managing the wreckage of what the warning signs had been pointing to all along. Here's something I want you to think about before we go further. The warning signs in Japan in the late 1980s were being discussed openly by economists and analysts at the time. They were not secret. They were not obscure. And yet, the vast majority of people with money in the market kept it there and often added to it. So the question is this: if the warning signs are visible and discussed and even understood, what stops people from acting on them? Drop your answer in the comments, seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. This leads to the second part of this story, and the second warning sign. This one is subtler than inflated prices. It is, in many ways, more dangerous. Greece entered the 2000s as a country with a serious and long-standing problem with its public finances. The government was spending more money than it collected in taxes, which created what economists call a deficit, meaning a gap between income and spending, that has to be filled by borrowing. Greece had been running these deficits for years, but the warning sign was not the deficit itself. The warning sign was the fact that the deficit was being systematically hidden. When Greece joined the Eurozone, the group of European countries that share the euro as their currency, in 2001, it did so by presenting financial data that did not accurately reflect the true state of its public finances. The deficits were understated. The debts were obscured through complex financial arrangements. In 2004, a revised accounting exercise revealed that Greece had never actually met the fiscal criteria required for Eurozone membership in the first place. The deficit figures previously reported were wrong. By how much exactly has been debated, but revisions showed the true deficit in the years around Eurozone entry was roughly twice what had been officially stated. For several years after 2004, this revelation produced commentary, criticism, and concern in financial circles. But then something happened that buried the warning sign under a different kind of noise. The global economy entered one of the longest sustained booms of the modern era. Money was cheap and available. Banks across Europe were lending freely. And Greece was borrowing, cheaply, at interest rates barely higher than Germany's, the Eurozone's most financially conservative economy. The market, through its pricing of Greek debt, was essentially saying it did not believe Greece would default. And because the market was saying that, and because cheap money was flowing, and because growth numbers looked reasonable, the warning sign, the false accounting, the structural deficit, the dependency on cheap borrowing receded into the background. By 2009, Greece's actual deficit was revealed to be around 12.7% of GDP, meaning the government was spending almost 13% more of the country's entire annual output than it was collecting in revenue. The real national debt was close to 130% of GDP. When the global financial crisis dried up the easy money that had been masking these problems, the entire structure became visible at once. Greece lost access to international bond markets in 2010. It required 3 separate international bailouts over the following years. Unemployment reached 27% by 2013. Youth unemployment exceeded 60%. Hospitals ran short of medicines. Pensions were cut repeatedly for people who had already retired. The warning sign, the falsified data, and the structural imbalance had been there for nearly a decade before the crisis arrived. What had changed was not the existence of the problem. What had changed was the environment that had been hiding it. This is the second warning sign. And when official data does not match observable reality, when the numbers that governments or institutions publish seem inconsistent with what is actually happening on the ground, that gap is a warning sign. It does not mean collapse is imminent. It means the foundation you're building on is not what you have been told it is. And building on a foundation you do not understand accurately is always dangerous, regardless of how long it holds. Now here is where it gets interesting, because the third warning sign is perhaps the most commonly visible and the most consistently ignored of all. And it has a specific name. It is called yield compression, and you will understand exactly what it means by the end of this section. Lebanon's financial system had been structurally compromised for years before the crisis of 2019. The Lebanese government was heavily indebted and had been running large deficits for decades. To finance those deficits, it relied on its own banking system. Lebanese banks bought enormous quantities of Lebanese government bonds. To attract deposits from the Lebanese diaspora and from international investors to fund this bond buying, Lebanese banks offered high interest rates on deposits, unusually high. By the late 2010s, Lebanese banks were offering deposit rates of 8, 9, and in some cases 10% per year on dollar-denominated deposits. This at a time when banks in the United States and Europe were offering rates close to zero. When a financial institution offers unusually high interest rates to attract depositors, it is communicating something, whether it intends to or not. It is communicating that it needs the money more urgently than its competitors. It is communicating that the risk it is carrying internally is higher than normal. In simple terms, it is paying a premium because the premium is necessary to attract capital that would otherwise go elsewhere. High interest rates in this context are not a gift. They are a warning signal dressed as an incentive. This pattern appears in the historical record with remarkable consistency. Before the savings and loan crisis in the United States in the 1980s, failing thrift institutions, meaning savings banks, attracted deposits by offering above-market interest rates that healthier institutions could not match. Before the banking crises in several developing economies in the 1990s and early 2000s, abnormally high deposit rates were a consistent precursor. Before the Lebanese collapse, economists were explicitly pointing to the deposit rate structure as unsustainable. Estimates suggest that by 2019, Lebanese banks were paying out more in deposit interest than the underlying assets they held could realistically generate. The math was, in a technical sense, impossible over any extended time horizon. The system was paying depositors with money it was effectively borrowing from other depositors. This structure has a name. It is called a Ponzi scheme when practiced by individuals and regulatory arbitrage, when practiced by financial institutions. The outcome, when the inflow of new deposits eventually slows, is identical in both cases. Most people will never know what you now know. Most people will keep trusting that high interest rates are simply good deals. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all three of these cases have in common. Japan in the late 1980s, Greece in the 2000s, Lebanon in the 2010s, 3 different countries, 3 different financial systems, 3 very different political histories and cultural contexts, and yet the same sequence appears in all 3. In Japan, the warning sign was a price level that no longer connected to the underlying value it was supposed to represent. The stories being told about stocks and property had become detached from the earnings and rents those assets actually generated. The valuation was circular. It was high because it had been going higher. And when the circularity broke, it broke completely. In Greece, the warning sign was a mismatch between official data and structural reality. The foundations of the system were not what the official numbers claimed. The ability to borrow cheaply masked the problem without resolving it. And when the masking environment, the era of cheap and plentiful global capital ended, everything that had been hidden became suddenly, terrifyingly visible. In Lebanon, the warning sign was a rate structure that communicated desperation while being received as opportunity. The price of money, the interest rate being offered, was itself the signal. And the signal was saying that the institutions offering it needed new deposits more urgently than a healthy financial system ever should. The same mechanism, different countries, different decades, same result. The underlying pattern is this. Warning signs are almost never presented as warning signs. They are almost always presented as features. High asset prices are presented as prosperity. Favorable borrowing conditions are presented as the reward of membership in a stable currency union. High deposit rates are presented as a generous return for loyal customers. The warning is real, but the framing is reassuring. And because the framing is reassuring, because the warning has been present for a long time without catastrophe, it gets incorporated into the background. It becomes part of the furniture. And people stop asking whether the furniture is stable. At this point, the pattern becomes impossible to ignore. And this is where history gets uncomfortable, because the people who paid the highest price in all 3 cases were not the people who created the conditions for collapse. They were the people who trusted the furniture. In Japan, the most damaged were the ordinary workers and small investors who had bought property or stocks near the peak, often with borrowed money, on the belief that the trajectory they had witnessed for years would continue. Many of them spent the 1990s and even the 2000s trapped in mortgages worth more than their homes. An entire cohort of Japanese workers entered their peak earning years carrying the weight of peak bubble debts. Economists studying Japan's lost decade have estimated that household wealth in Japan fell by the equivalent of trillions of dollars in the decade following the bubble's collapse. The specific figure varies by methodology, but the scale of the loss was generational. Not a short, sharp correction, a long, grinding, suffocating erosion of wealth that lasted years. In Greece, the specific cruelty was that the people who suffered most were frequently the ones who had been most careful and most rule-following. Pensioners who had worked in the public sector for decades and expected the pension they had been promised. Civil servants, teachers, small business owners in the service sector who suddenly found their customers had no disposable income. The bailout conditions, negotiated between the Greek government and its international creditors, required repeated rounds of pension cuts, tax increases, and public sector wage reductions. By 2016, the average Greek pension had been cut by more than 40% from its pre-crisis level. The people who had done everything the system told them to do found that the system's promises were not backed by the means to keep them. In Lebanon, the civil engineer we met at the beginning of this video was representative of an entire professional class. Doctors, engineers, university professors, accountants, people who had kept their savings in Lebanese. Banks, because Lebanese banks paid good interest, and because Lebanese banks had maintained their dollar peg and their stability through wars, political crises, and regional upheaval for decades. Their loyalty to the system was rational, based on evidence that stretched back years. The evidence was real. The stability had been real. Until it was not. Contrasted against these groups are the people who came through in notably better condition. In Japan, institutional investors and corporations that had moved significant portions of their portfolios into foreign assets before the bubble peaked maintained a degree of insulation. In Greece, individuals who held assets in non-Greek banks or in physical property outside. Greece maintained purchasing power through the crisis, even as those inside the Greek banking system suffered capital controls. In Lebanon, people who had transferred savings abroad to accounts in Cyprus, in France, and the United States before the capital controls were imposed, retained access to their money. The common thread is not wealth. The common thread is location, inside a failing system versus partially outside it. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the people who preserved more of what they had built actually tend to do differently? The historical record on this, examined across Japan, Greece, Lebanon, and other comparable events, is consistent enough to be worth examining carefully. And this, again, is pattern recognition based on the historical record. It is not financial advice. Every person's situation is different, and nothing here should be taken as a recommendation for any individual. The historical record shows that those who came through these periods with more intact largely shared three characteristics. The first was that they treated official reassurances as data points, not conclusions. In every one of these cases, the period immediately before the crisis was characterized by official statements from governments, central banks, and financial institutions affirming that the situation was stable, that the warnings were exaggerated, and that the fundamentals were sound. In Japan, in late 1989, official voices were still talking about the resilience of the Japanese economy. In Greece, in 2008 and 2009, the incoming government's discovery that the deficit was twice what had been reported was treated by many as a technical adjustment rather than a systemic exposure. In Lebanon, the central bank governor, Riyad Salameh, consistently maintained until very late that the financial system was sound. The people who acted on the warning signs rather than the official reassurances were not contrarians for its own sake. They simply did not allow official communication to override observable evidence. The second characteristic was that they moved early enough to move calmly. This is perhaps the most practically significant finding in the historical record. In every one of these crises, there was a window, sometimes months, sometimes years, when action was possible without significant cost or disruption. In Lebanon, transferring money abroad was legal and straightforward until late 2019. People who did so in 2017 or 2018 did so without penalty, without stigma, and without urgency. People who waited until October of 2019, when the protests began, found the window closing rapidly. The bank controls came weeks after the protests. The people who moved early did so not because they had better information about the exact timing of the crisis. They moved because they had recognized the warning signs and acted on them while action was still frictionless. The third characteristic was that they understood the difference between the performance of an asset and the health of the system holding that asset. High deposit rates in Lebanese banks were delivering excellent returns right up until they stopped. Japanese stocks were delivering excellent returns right up until they stopped. The performance was real. The question the survivors were asking was not whether the returns were real today, but whether the system generating them was structurally capable of sustaining them. They were asking a different question than most people were asking. And the different question led to different decisions. Now we return to Beirut, to the 7th floor apartment in Hamra, to the Friday night restaurant and the 22 years of pension contributions. The civil engineer did not lose his home. He still lives in the same apartment. But by 2022, his bank savings, the $68,000, were effectively inaccessible at any rate that reflected their real value. His pension payments continued to arrive, in Lebanese pounds at the official rate. In real purchasing power, his monthly pension had lost, by some estimates, around 80% of its pre-crisis value. The Friday night restaurant had closed. The neighborhood had changed. Many of his colleagues had emigrated. The careful life he had built over decades of disciplined, rule-following work had been substantially dismantled not by his choices, but by the failure of a system whose warning signs he had not been equipped to read. This is not a story about incompetence. It is not a story about recklessness or greed. It is a story about what happens when warning signs are consistently normalized, consistently reframed as features rather than dangers, and consistently buried under official reassurance until the moment when they cannot be buried anymore. Every crisis in this video was preceded by visible, discussable, documented warning signs, valuation disconnects, data inconsistencies, structural rate anomalies. In every case, the warnings existed. In every case, most people did not act on them, and in every case, the people who did not act paid a price that bore no relationship to the caution or care with which they had lived their financial lives. History does not promise that warning signs will always precede collapse. Sometimes events arrive without sufficient lead time. But history does strongly suggest that when warning signs are visible, the cost of acting on them early is almost always lower than the cost of ignoring them until they are impossible to ignore. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.